Hi guys, this is Sia Jane and welcome back to my channel ACCA and beyond. So in the previous video we had started with the conceptual and regulatory framework chapter and we had to stop in between. So we are going to continue it with the conceptual framework in this video. Okay. Uh, so what exactly is a conceptual framework? Remember earlier we discussed two approaches to accounting. First was a principle based approach, which is used by the IASB, and the second is the rules based approach, which is mainly used by the US. Today we are focusing on the principles based approach. What is a conceptual framework? Think of the conceptual framework as a blueprint of a house. Before you start building the walls, doors, and windows, you first need a blueprint. Similarly, before creating accounting standards, the IASB first follows a conceptual framework. It is a set of fundamental principles and objectives that guide how accounting standards should be developed. In simple words, the conceptual framework is a foundation on which all accounting standards are built. Why do we need a conceptual framework? Now you might wonder, why not just create accounting standards whenever a new problem comes up? Because that creates confusion. Let's see why a conceptual framework is important. It provides a common foundation. The first benefit is that all accounting standards are based on the same principles. Instead of every accounting standard following a different logic, they all follow one common foundation. Second, this is a favorite example. Imagine a school that creates a new rule only after student breaks one. No planning, just reacting. That's called firefighting. Similarly, without a conceptual framework, accounting standards would be created only when a problem appears. This can lead to inconsistent rules. The conceptual framework prevents this by providing clear principles before problems arise. Third, the early accounting standards didn't even clearly define basic terms like asset and liability. The conceptual framework solves this by giving proper definitions of key accounting concepts. Fourth, the business is constantly changing. New technologies are and new types of transaction appear every year. Sometimes there is no specific accounting standards for a new transaction. In such cases, the accountants and auditors can use a conceptual framework to decide the most appropriate accounting treatment. Fifth, principle based standards focus on the substance of a transaction rather than just following the technical rules. This makes it much harder for companies to exploit loopholes or manipulate financial statements. Sixth point, when everyone follows the same principles, financial reporting becomes more reliable. This improves public trust in both financial statements and the accounting profession. 7. Without the conceptual framework, large companies might pressure standard setters to create rules that benefit them. But when accounting standards are based on established principles, it's much harder for special interests to influence the standard setting process. Okay, now let's study about the alternative approach. We just learned that the IASB follows a principle based approach, but there's another approach called the rules based system. Think of it like following a recipe. The recipe tells you exactly what to do. There's a very little room for personal judgment. That's exactly why a rules based system works. This approach is mainly used in the United States. Now let's see at the advantages. So why do some countries prefer rules instead of principles? There are four main advantages. Since every rule is clearly written, there's less confusion about what companies should do. If everyone follows the same exact rules, comparing different companies becomes easier. Auditors can easily check whether a company has followed the required rules. And fourth, companies simply follow the rules, there's less personal judgment involved, reducing the chances of different accountants reaching different conclusions. So, which approach is better? Although the rules based systems have advantages, the IASB believes that principle based standards are better. Why? Because some clever companies can sometimes find loopholes in detailed rules. If the rules don't specifically prohibit something, they may exploit it. So, principles are much harder to manipulate because they focus on the true substance of a transaction rather than just ticking boxes. Now, let's look at the purpose of conceptual framework. The IASB framework is officially called the Conceptual Framework for Financial Reporting. It provides guidance on four major areas: the objective of financial reporting, the qualitative characteristics of useful and financial information, and the definition, recognition, and measurement of assets, liabilities, income, and expenses. The concepts of capital and capital maintenance. Think of it as the instruction manual the IASB uses before writing any accounting standard. Why was the framework created, you might ask? The framework has three main purposes. First, it helps the IASB develop consistent IFR standards. Instead of creating standards randomly, everything is based on the same principle. Second, it helps accountants. If there is no IFRS standard for a particular transaction, or if a standard allows more than one accounting policy, the framework helps accountants choose the most appropriate treatment. Third, it helps everyone else. Investors, auditors, students, and companies can use the framework to understand and interpret IFRS standard. One more very important exam point. Here's a favorite exam question. Is the conceptual framework itself an IFRS standard? The answer is no. The framework provides guidance, but it is not an accounting standard. So what happens if framework and an IFRS standard say different things? In that rare situation, the IFRS standards always takes priority. Please note this down. Just remember this golden rule: framework guides, IFRS standards decide. I'll write it down for you. Okay, let's move on. Now we'll answer a very basic question: objective of financial reporting. Why do companies prepare financial statements in the first place? Is it to just satisfy accountants? Not at all. The objective of financial reporting is to provide useful information or useful financial information to people who need to make decisions. These users include investors, lenders, creditors. They use financial statements to answer questions like: should I invest in the company? Should I lend money to it? Will the company be able to repay me? So, in one line, the objective of financial reporting is to help users make informed economic decisions. Now, let's look at the qualitative characteristics. The information also needs to be useful. That's where qualitative characteristics comes in. Think of qualitative characteristics as the qualities of good financial information. The IASB divides them into two categories: fundamental qualitative characteristics. These are absolutely essential. Without them, financial information isn't useful. They are relevant and relevance and faithful representation. Second, enhancing qualitative characteristics. These don't make information useful by themselves, but they make useful information even better. Their comparability, verifiability, timelessness, and understandability. Now let's look at the underlying assumption, which is about going concern. Before preparing financial statements, accountants make one very important assumption. It's called the going concern assumption. Imagine you own a restaurant. When preparing this year's account, you assume that the restaurant will continue operating next year. You don't assume that you are going to close it tomorrow. That's exactly what the going concern concept means. It assumes that the business will continue operating in the foreseeable future and has no intention or need to shut down or significantly reduce its operation. If this assumption is not true, then the financial statement must be prepared on a different basis and the fact must be disclosed. Easy way to remember this is: the going concern is that the business is here to stay. Now let's look at the fundamental qualitative characteristics. Let's start with the first fundamental characteristics, which is relevance. Information is relevant if it can influence a decision of users. For example, suppose you are deciding whether to invest in a company, knowing that the company made 100 crore rupee loss this year would definitely affect a decision. That information is relevant because it helps you make a better decision. That's one more important point. Relevant information must also be provided on time. Imagine receiving last year's financial statements after you've already invested. Even if information is accurate, it's too late to influence your decision. Now let's talk about materiality. You all often hear another word along with relevance, which is materiality. What does it mean? Is the information important enough to affect a user's decision? For example, if a company accidentally records a rupee 10 expense as 12, that probably won't change anyone's investment decision. It's immaterial, that's fine. But if the company hides a 10 crore rupee loss, that's definitely material because it could influence investors' decision. So remember, material information is always relevant because it can affect decision making. Okay. Now let's talk about qualities of relevance. Earlier we learned that relevance means information should help users make decisions. But how does it help? There are two ways. First is the predictive value. Predictive value helps users predict the future. For example, if a company's profit have been increasing every year, investors may predict that the company will continue performing well. So past and present information helps user estimate future performance. So simply remember, predictive value equals to helps predict future outcomes. Second, we have the conformity value. A conformity value is the opposite. Instead of predicting the future, it confirms whether your earlier prediction was correct. For example, last year predicted a company would grow. This year's financial statement show that profits actually increase. That information confirms your earlier decision. So, conformity value equals to conforms or corrects past expectations. Um, Sometimes accountants have more than one acceptable accounting treatment. In such cases, they should choose the option that provides the most useful information to users. In other words, choose the option with the highest relevance. Now, again, we'll talk about materiality. Now, materiality depends on both the size of the item and the circumstances. For example, losing rupees 100 may not matter to a large company, but losing rupees 100 crore certainly does. So, materiality isn't based on one fixed amount. It depends on whether information could influence users' decisions. Materiality, the framework calls materiality a threshold quality. Think of it as a security check at an airport. If you don't pass a security check, you cannot go any further. Similarly, if information isn't material, there's no need to spend time evaluating its other qualities. It simply isn't important enough to affect a user's decision. Now, let's talk about faithful representation. It simply means financial statements should show the true economic reality of a transaction, not just its legal wording. Imagine this: a company legally calls something a loan, but in reality, it's actually an investment. Accounting should reflect what it really is, not just what it's called. That's what we mean by substance over form. Always record transactions according to their economic substance, not merely their legal form. Now let's talk about the characteristics of faithful representation. For information to faithfully represent reality, it should have three qualities. First, completeness. Nothing important should be missed. This information should include all necessary explanations and details so users can properly understand it. Second, neutrality. Information should be unbiased. Financial statements should not be prepared to make the company look better or worse than it actually is. They should represent the facts exactly as they are. Third, we are free from error. This means that the information should be free from material errors or omissions. Why? Because if an important mistake is made, the financial statements could become misleading. But here's an exam point, important one. Free from error does not mean 100% perfect. Accounting often involves estimates. For example, a company may estimate the useful life of a machine to be 10 years. No one knows the exact future. That's perfectly acceptable, as long as it's reasonable estimate and the company clearly states that it's an estimate. Okay. Okay, let's talk about the enhancing qualitative characteristics now. Uh, so I'll give you a quick memory trip, which is CV to you. Comparatively, verifiability, timelessness, and understandability. These characteristics don't make information useful on their own. Instead, they make relevant and faithful represented information even more useful. Now, let's start with comparability. Imagine you are buying a phone. Of course, would you compare only one phone? Of course not. You'll compare different brands, prices, and features before making a decision. Financial statements work the same way. Should be able to compare a company's performance over different years and different companies with each other. Okay, these helps investor identify trends and make better decisions. Um, Now, consistency makes comparability possible. For comparison to work properly, companies should use consistent accounting policies. For example, if company uses one depreciation method this year and a completely different method next year, without a good reason, comparing the 2 years becomes difficult. Um, Accounting policies must also be disclosed. Imagine two students solve the same math problem. One uses a calculator, the other solves it manually. If you don't know which method they used, comparing their work becomes difficult. Similarly, companies must clearly disclose the accounting policies they have used. And if those policies change, they must also disclose what changed and how that change affected the financial statements. The transparency helps users make fair comparisons. Another exam point is that the financial statement shouldn't show only this year's figures. They should also include last year's figures. Why? Because users want to compare performance over time. For example, if this year's profit is 50 lakh, is that good or bad? We can't tell unless we compare it with last year's profit. That's why financial statements include comparative information from the previous period. Next comes verifiability. Verifiability means that different knowledgeable people should be able to check the information and reach the same conclusion. There are two types. Direct verification. This is the easiest type. You verify something through direct observation. For example, counting the cash in the cash box. No calculations are needed, you simply count it. Second is your indirect verification. Sometimes you can't verify something directly. Instead, you check the calculations. For example, you verify inventory by checking the formula used and recalculating the value using the same method, such as FIFO. So remember, verification is about observing it directly, and indirect is about recalculating it. Next comes your timelessness. Financial information should be available before people make decisions. Imagine a company publishes its financial statements 2 years late. Even if the information is perfectly accurate, it won't be very useful to the users. That's why the older the information becomes, the less useful it becomes. Simply remember, right information at the right time, that's timelessness. Finally, we have understandability. Financial statements should be presented clearly and logically so users can understand them. This, but this doesn't mean companies should oversimplify everything. The IASB assumes that users already have a reasonable knowledge of business and accounting, and they are willing to read and analyze the information carefully. So the company should present information clearly, but users are also expected to put in reasonable effort to understand it. Now that we have understood the conceptual framework, let's look at the building blocks of the financial statements, also known as the elements of financial statements. These are your 5 elements, which are the asset, liability, equity, income, and expenses. So let's understand each one in simple language. And first we have your asset. An asset is the framework defines an asset as a present economic resource controlled by the entity as a result of past event. This sounds technical, so let's simplify it. Think of an asset as something the business controls today that can generate future economic benefits of something that happened in the past. For example, a company buys a machine today. The purchase is a past event. The company controls the machine, and the machine will help generate future benefits. And so that's an asset. Now, what is an economic resource? The framework also says that an economic resource is a right that has the potential to produce economic benefits. For example, owning a building gives you the right to use it, rent it, or sell it. That right can generate future benefits. Second, we have your liabilities. A liability is a present obligation to transfer an economic resource because of a past event. In simple words, a liability means the business owes something because of something that already happened. For example, a company buys good on credit. The purchase has already happened. Now the company has an obligation to pay the supplier in the future. That's a liability. The easy trick to remember is the liability is a present obligation because of a past event. Third, let's talk about equity. Um, Think of it what's left after paying all liabilities. The formula is very simple. Equity equals to asset minus liabilities. For example, if a company owns assets worth 10 lakh and owes 4 lakh rupees, then equity equals to 6 lakh rupees. So equity is simply the owner's remaining interest of the business. Fourth, we have your income. Income isn't just cash received. According to the framework, income means an increase in asset or a decrease in liability, which uh, which rules in an increase in equity. But there is one exception. If the owner invests more money into the business, equity also increases. That's not income. It's simply the owner's contribution. Fifth, you have your expenses. Expenses are exactly the opposite. Expenses means a decrease in asset or an increase in liability, which results in a decrease in equity. Again, there is one exception. If the business pays dividend to the owner, uh, one second. Okay, so let's talk about the breaking down of definitions. First is your assets. We already know that the definition of an asset is a present economic resource controlled by the entity as a result of past events. Now let's understand the important words in that definition. Controlled by the entity. The key word here is control, not ownership. Control means the company can use the asset to earn economic benefits and prevent others from using those benefits. For example, a company owns a machine and uses it to manufacture products. Since the company controls the machine and enjoys all its benefits, it's an asset. Even if the company decides to sell that machine later, it's still exercising control over it. Second is your past events. An asset cannot exist because of future promise. Something must have already happened. For example, suppose a company orders a machine today. Has it become an asset immediately? Not necessarily. It becomes an asset only when the company actually gains access or control over the machine, depending on that contract. So remember, no past event, no asset. Now let's do the same for liabilities. We know the definition is a present obligation to transfer an economic resource as a result of past events. Now let's understand the keywords. First is your obligation. An obligation can be of two types. Legal obligation. This is created by law or contract. For example, if a company signs a loan agreement, it's legally required to repay the bank. That's a legal obligation. Now we have your constructive obligation. This is a little different. There's no law forcing the company to do something. Instead, the company has created an expectation through its own actions or policies. For example, suppose a company publicly promises, we will always clean up our environmental damage caused by our factories. Even if there's no law requiring it, people now expect the company to keep that promise. That creates a constructive obligation. Second, we have the past event. Just like assets, liabilities also require a past event. Uh, it's the same what we discussed for assets. And assets and liabilities are like mirror images. Now, one final concept we have, the framework says that the assets and liabilities are complementary, or you can think of them as mirror images. Why? Because many transactions create both an asset and a liability at the same time. For example, a company buys inventory on credit. It receives inventory, which is an asset. At the same time, it owes money to the supplier, which is a liability. So, one transaction can increase both assets and liabilities together. Okay, next we'll talk about equity. We have already learned the formula, which is assets minus liabilities. But let's understand what that really means. Imagine a company owns asset worth 20 lakh. It also owes 8 lakh to banks and suppliers. What's left? 12 lakh. That remaining amount belongs to the owners. That's called equity. So in simple words, equity is the owner's residual interest after paying all liabilities. An owner's wealth doesn't increase only when they invest more money. It can also increase because the business earns profit. That's why equity is usually divided into different parts, such as money invested by owners, profits retained in the business, also called reserves, and this helps users understand where the equity comes from. Now, here's an important question. Just because of something meets the definition of asset or liability, does it automatically appear in the financial statements? No. It must first satisfy the recognition criteria. Think of the recognition criteria as an entry ticket. Meeting definition is step 1. Recognition is step 2. Only after passing both steps can the item appear in a financial statement. So when is an item recognized? An element is recognized only if doing so provides useful information. This means that the recognition should provide relevant information. The information should help users make decisions. If there's a lot of uncertainty about whether the assets or liabilities even exist, recognizing it may not be useful. Similarly, if it's very unlikely that economic benefits will flow into our business, recognition may not be appropriate. Second, we have a faithful representation. Recognition should also be faithfully represent reality. If the value of an asset or liability is so uncertain that it can't be measured reliably, recognizing it could actually mislead users. In such cases, it may be better not to recognize it. Example, we have your contingent liabilities. Let's look at this example. Suppose a company is being sued. Will it immediately record a liability? Not necessarily. If it's not probable that the company will have to pay, then under IAS 37 it's treated as a contingent liability when it is not recognized in the financial statements. Why? Because the future outflow of resources is still uncertain. The same idea applies to contingent assets. They are also not recognized because the future inflow of economic benefits is sufficiently certain. So, judgment is important. Accounting isn't always black and white. Sometimes accountants need to use professional judgment. That's why different IFR standards have different recognition criteria depending on the type of asset or liability involved. What if an what if an item isn't recognized? Just because something isn't recognized doesn't mean it's ignored. Sometimes IFRS requires the company to disclose the information in the notes to the financial statements. This helps users understand important economic event, possible future risk, and potential future cash flows. So even if an item doesn't appear in the balance sheet, it may still be explained in the notes. Okay, now the financial position approach to recognition. Earlier we defined income as the increase in assets or decrease in liabilities, and expenses as decrease in assets or increase in liabilities. Notice something, both income and expenses are determined by changes in assets and liabilities. That's why the IASB follows the financial position approach, also called the balance sheet approach. Instead of asking, did the company earn more, the IASB first asks, did the company's assets or liabilities change? If assets or liabilities increase or decrease, it usually results in income. If assets decrease and or liabilities increase, it usually results in expenses. Sorry, I earlier said a wrong statement. If assets increase and liabilities decrease, it leads to income. Okay, I said it wrong earlier. And if assets decrease and liabilities increase, it relates in expense. Okay, so now let's move on to derecognition. It's the opposite of recognition. If recognition means adding an asset or liability to the financial statement, then derecognition means removing it. Simply put, derecognition equals to taking an asset or liability of the financial statement position. So, when does derecognition happen? There are two main situations. Um, First, we have your assets. An asset is derecognized when the company loses control over it. For example, if a company sells a machine and no longer controls it, the machine is removed from the balance sheet. Second, liabilities. A liability is recognized when the company no longer has a present obligation. For example, if a loan is fully repaid, the liability disappears and is removed from the balance sheet. So, what happens during derecognition? Whenever an asset or liability is removed, the company should also remove the part that's been transferred, used up, or expired. Recognize any gain or losses arising from the transaction. Continue recognizing any part that the company still controls. Now we have just an important example point. Just because an asset is sold doesn't always mean it should be de-recognized. The key question is, has the company actually lost control? If the company still controls the economic benefits, de-recognition may not be appropriate. An example we look at is that suppose a company sells a building for 2 million, but there's a special agreement. The company has the right to buy the same building back after 5 years or for 3 million. At the time of the sale, the building is actually worth 7 million and the property prices are expected to keep rising. So here's the question, should the company remove the building from its balance sheet? No. Why? Because even though it appears to have sold a building, it still has the right to buy it back from much less than its expected future value. That means that the company is still benefiting from the building's future economic value. So, in substance, control hasn't really been lost, therefore, the building is not de-recognized. There's another example of an important accounting principle. Always look at the economic substance of the transaction, not just its legal form. With this, we are finally done with this chapter. It was a bit of a very lengthy chapter, and it's lengthy because it has so many concepts. That's why. But I tried to make it a little simple for you guys. I really tried. So if you liked it, please like, share, subscribe to my channel, share it with your friends. And thank you so much for watching. I'll see you guys in the next one.